We're monetary metal masters. And right now, something very important is happening in gold, silver, and copper, but most people are being pointed in the wrong direction. Before we start, this is not financial advice. This is education only. Core thesis. Every single year, around Q4 and year-end reporting season, you'll notice the same thing. Gold stalls, silver gets hit harder, copper suddenly looks weak, and people are told, see, last year was just a temporary spike. Nothing structural. Back to normal. But that story only works if you ignore how pricing actually works in these markets. Gold, silver, and copper are not primarily priced in the physical market. They're priced in paper markets, COMEX, LBMA, futures, forwards, unallocated contracts. And here's the key point most investors miss. Lower prices into year-end help a lot of balance sheets, banks, bullion desks, industrial hedgers, even some miners. Because Q4 price is set, year-end valuations, inventory marks, cost assumptions, hedge book optics. If prices are pushed down just enough, the narrative becomes, last year was an outlier. Nothing has really changed. But that story only works if you ignore how pricing actually works in these markets. But silver breaks that illusion. Silver has a structural deficit, not a cyclical one. Industrial demand keeps rising. Solar EVs, data centers, AI infrastructure, defense, and electronics. And unlike gold, silver gets consumed. We've now had multiple consecutive years where total demand, mine supply, plus recycling. That is not a trading story. That is a physical math problem. Copper is showing the same pattern. Electrification, grids, EVs, renewables, massive future demand. Yet prices get capped into reporting periods because if copper looks too strong, inflation expectations explode. So, again, price suppression optics, not fundamentals. So when prices dip into Q4 and early Q1, people conclude, see, the rally failed. No. What you're seeing is paper pressure colliding with physical reality, and that collision never resolves gently. Now here's the irony. While prices are pushed down, miners report Q4 results. Costs stabilize, cash flow improves, debt comes down, so fundamentals improve while sentiment stays weak. That's not bearish. That's classic late cycle behavior. Silver is not rising because of hype. It's rising because there isn't enough metal. Gold isn't rising because of fear headlines. It's rising because central banks are draining supply. And copper isn't cyclical weakness. It's future scarcity being delayed on a chart. If you want to understand what's really driving these markets, not just the price you see on a screen, visit the link in bio, because the paper story and the physical story are no longer the same thing.